All right, folks, welcome back to the Property Couch podcast, and we are very excited to bring you Q&A day. We've got big questions that you want answered, and we're going to cover them off, including, Ben, are we influencing the discussion around brand new properties and affecting the housing and rental crisis? We cover that, and we also talk about what you and I are teaching our kids around money. What else are we going to cover?
Well, mate, there's not much we're teaching them. But anyway, what we're going to talk about when it comes to what's making property news, big story, big data stories. We saw the release of the data coming out from the ATO around the number of property investors. So we'll be sharing that data. And the trend isn't our friend, unfortunately. That's what happens when you get lots of intervention from government. And then finally, there's a really interesting report that's come out about the intention of property investors in Queensland if the Queensland government keep knocking property investors on the head. Well, we'll share that number of people who are willing to get rid of their properties in Queensland if they keep interfering in the market. So big what's making property news section.
Big news to cover today. And I also talk about the possibility of becoming a Collingwood supporter. Is that even possible? Let's find out. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. And as I say to you every week, mate, welcome back to you too.
Mate, thanks for having me back. It's always a joy to do this podcast with you. We banter, we wax lyric on all things property finance and money management. It's always good stuff.
We do. We've got a Q&A day today, so nothing to see in the footy stakes. Should we just move straight on?
No. You didn't hear me. I was saying, looking forward to having a chat this week. Mate, seriously, you have jinxed your football club. Get off them straight away. It's ridiculous.
Yeah,
like you have a little time off and now you're back. And what happened? Look, the only thing I could say here, right, in terms of how must it be living in the West at the moment? Like both footy teams are really struggling. I mean, you just got to look to your WA cricket team, don't you? They keep winning everything over there, so maybe you're thinking about the cricket season already.
You're up and about. No, well, they just trot out the same line they've always done in Western Australia when they lose their team: sack the coach. That's the standard line.
Got to blame someone.
I've got a strategy, mate. I've got a strategy. Okay. So, in terms of I've had to reflect on the fact that when I'm having a gap year, they're winning, and when I'm actually putting concentrated energy into it, they're losing, right? And I've bought a Geelong membership this year.
That's going well for you.
My eldest follows Geelong, so they're obviously now in the lower half of the draw of the ladder. So I've decided, I'm going to announce it here.
Right.
For the rest of the season, I'm going to follow Collingwood.
Great strategy. What a great strategy.
Collingwood.
All right, so there goes our top 4 chances.
I'm passionately hoping that you win the flag. I hope that you don't lose any games. I hope Jordan McGowan comes back as quick as possible. I hope that you continue to have heaps of fun with your team and they look like they're enjoying their footy. I'm just passionate about Collingwood, mate. I cannot wait to see what you do for the rest of the season.
Oh, that's very good, very good. Hey, have you got a prediction for me? Freo going to make the finals?
Well, I don't know, mate. I'll tell you when I get back from the gap here if they do or not. But the only chance I've got is not making a prediction and not putting any energy that way, and hopefully
that's true. That's true. Hey, big day today. Q&A.
Q&A day today. Well, we've got some great questions from the good people from our community. So let's head that way, Ben. On the way through Mindset Minute. So I'm up to number 7 with the anecdotes of the art of spending, which I'm enjoying. I hope everyone else is. We're up to number 7, which says social aspirational spending, which is trickled down consumption patterns from one social economic group to the next. Ben, have a little lean into this. Let me know your thoughts at the end, right? But
sure.
The economist Joseph Stiglitz, and obviously I'm reviewing what Morgan's saying, said trickle down economics may be an error, but trickle down behavioralism is very real. So what does he mean by that? Well, it says there's no such thing as an an objective level of wealth. It's just everything is just relative to something else. So people look around and they say, what's that person driving? Where are they living? What kind of clothes are they wearing? Their aspiration is calibrated according to those around them. But it actually would be nice to have that form of objective wealth. We're trying to make our line in the sand around that, Ben. It's accumulating enough assets to get 2,000 a week, but I digress. So Kevin Kelly, who's the Wired magazine founding editor, made this observation. If you want to know what lower income groups are going to aspire to spend their money on in the future, look at what higher income groups spend exclusively on today. All right, so here's some examples. European holidays once were the exclusive playground of the rich, and then it trickled down to the merely wealthy, and then down to the middle class. And so that's true, Ben. There's a lot of people now go on European holidays. College education used to be reserved only for the highest earning households, and then it spread right down to the affluent, then middle class, and then the lower ranks. Investing in 1929, the peak of the roaring 20s stock bubble, only 5% of Americans owned stocks reserved for the very wealthy. Today, greater than 50% of US households own stocks via their 401k, aka super, or the Robinhood accounts where they get easy access to buying stocks over there. So think for more examples, 2-car households, lawns, walk-in robes, granite benchtops, 6-burner stoves, jet travel, even the entire concept of retirement. All these things started as the exclusive domain of very wealthy people, and then it worked its way down throughout society. So part of the reason that these products spread and became available to the masses is because they became cheaper and there was greater access. But the reason they got cheaper is because there was so much demand from the masses, hungered, underline here, hungered by their aspirations that push companies to innovate for new ways of mass production. So here's the conclusion. People like to mimic others, especially those who appear to be living better lives. It's always been like that, and it always will be like that. So then I thought, well, what could possibly be next then, Ben? So I started to think about what is it that the exclusive to the rich. Well, we can have jet travel now, in economy, but private jet travel, will they get that commoditized to a place that everyone can get access to it? Personal drivers, tickets to outer space, Ben, at some point in time, we will get access to that. Private islands, will there be a way that we can get access to these private islands in a way that's affordable? Super yachts, can we get onto super yachts? I don't know, Ben, but just playing through the game of whatever the exclusive mega wealthy are doing now, that will trickle down to us at some point in the future, and that's the way it is. Interesting, huh?
Yeah, I've read a bit about the trickle down economics, and I'm not necessarily a believer that it is as true, but I do believe in human behaviour, and that is that people who run companies tend to think that they should earn more money, and so I tend to agree that those people get paid higher wages, and that is a trend that we've seen basically throughout a long period of time. But I also believe that through innovation, through technology advancement, and what you were just talking about there in terms of bench tops and alfresco areas and those lifestyle elements, things become cheaper and cheaper. And the reason for that, I know I'm going very, very boring and technical, but the reason for that is that businesses are always looking for opportunities. Now, usually in luxury good areas, the margins are really high. So you're normally seeing businesses making margins around 50% or even beyond in some cases in cosmetics and some type of clothing areas and all those type of things. So when you get, such high margins, other businesses are looking at you and saying, well, I want a bit of that action. And it's proven that the marketplace is showing that demand. So through that sort of evolution of competition and innovation and bringing those costs down, it then trickles down to everyone in terms of being able to enjoy that. In terms of your list there, the private island stuff could be interesting. There's obviously a limited number of islands, but certainly this whole idea of fractional access and consumption access to things like private jets. So we have a company here in Melbourne where you can buy a seat on a private jet, and if that jet's going, you can subsidise each other's costs. I do see a lot more of that sort of stuff happening, but it's definitely an interesting observation that, yeah, if that is true that the elite and the high end have, and we all aspire to that, then businesses will find a way, companies will find a way to then make that mainstream, and that is usually speaking, pretty good for lifestyle elements and prosperity and standard of living and quality of living. And it also happens in medical and all of those other fields as well. So where eventually things become democratized and they're available in a cheaper form so everyone can enjoy it. So if you stop that innovation, if you stop that cycle, you run the risk, and we've seen this in obviously studies of socialism, and why it didn't work is because ultimately, because there's not that stretch, that incentive, that economic incentive, usually you see innovation slow down, and that ultimately affects standard of living, and you don't get the same type of outcome. So capitalism is not perfect, but it's a good example of where it does play into, ultimately over the longer term, a better standard of living and a better quality of life.
So there you go. If you want to know what the lower income groups are going to aspire to spend their money on in the future, look at what higher income groups spend exclusively on today. So that one was number 7, social aspirational spending. Number 1 was your family background and past experiences influence your spending preferences. Number 2 was entrapped by spending. Number 3 was frugality inertia. Number 4 was the emotional attachment to large purchases. Number 5, the joy of spending can diminish as income rises. Number 6, asking $3 questions when $30,000 questions are all that matter. Of course, today was number 7. We'll cover number 8 next week, Ben, and then we'll take a little hiatus as we go through our winter series, which is coming up, which you and I are super excited. We give a little sneak peek that some of the stories, Ben, that we're going to cover on the winter series are epic. They are super exciting and super insightful. And pleased to know that the agenda for the people that wanted to come onto our winter series, Ben, because we've spoken to a few of them already, that they just wanted to give back. They said, we'd listened to the winter series and the summer series prior, and we saw that there was a heap of takeaways that we got from that. So we wanted to give back. So we're excited about that, which is really cool.
We are.
All right, Q&A day today. We've got 2 that have come through through email and 2 that have come through SpeakPipe. We'll go through the written ones first. The first one is from Ryan. And Ryan says some negativity from you and I around new properties and apartments. And this is Ryan's question. Ryan here, long-term listener, more platform user, have got through the property plan with your team. I've just listened to your pod admonishing the Greens for not backing the government bill to provide $10 billion for social housing, which I agree with. However, how do you reconcile your negativity around new properties and apartments with the fact that we gravely need this product type to deal with the rental and housing crisis? If everyone buys established, how does that map onto your stated concerns around everyone's right to a place to live? You guys are probably much more widely listened to than you ever expected, but with great power comes responsibility. Maybe you need to stop advising so heavily against new if you truly care about the impending housing and rental crisis. I've been stewing on this for a while and would love to know your feedback. Ben, are we contributing to the impending housing and rental crisis with our views on new properties?
Well, I think Ryan gives us an amazing opportunity to clarify our position on this area. So if that's the way Ryan's feeling, I'm pleased that he's reached out to us to allow us to share our views. And I want to start, can I firstly just start addressing the Greens' decision to block this, and make it a serious political football. And so basically what that means now is now that obviously Parliament will go into the winter break, and we won't be basically debating this policy again until October. That's a real problem, considering that the government was willing to spend, a minimum of $2 billion and get that money into building that critically needed social and affordable housing, and that to me is something of a interesting move. It reminds me very much of their move that they did with the carbon tax, and that backfired on them as well. So I think they've done a good job in terms of keeping the tension in this story. But to block it and to continually come after rent freezes, that would be the most diabolical thing that we could ever do in this country if we want to provide critical supply to those people who are, needing rental accommodation across this country. So I just want to basically, again, focus on the fact that the Greens Party has done a disservice to our economy, a disservice to the people that they're meant to actually be supporting for their own political gain. And I think that's really disappointing. Let's move on to the conversation at hand that Ryan's asking about. And this is about new versus old. We want to make it really, really clear that we're fully supportive of as much new supply coming into market. And we're talking about newly constructed homes, newly constructed apartments, villas, townhouses, whatever that looks like, to meet the growing needs and desires of the Australian community. That has never been what we're talking about here. We need to separate the owner-occupier, a great Australian dream desire to eventually one day own a home, and that is true. And we also recognise that there will be some investors who will choose to buy new to support that particular story. Where we come from really clearly is the fact that if you're talking about getting a secure invested return on your money, because you're talking about investing and borrowing tens of thousands, hundreds of thousands of dollars here, you want to give yourself the best opportunity to make sure that that money gives you a return. And what we're arguing from that point of view is where we see the safest bet is in the land to asset ratio, and making sure that, obviously where you're buying that land and where that improvements on the land are, historically speaking, you'll get a better return in buying existing over buying new. So two things can be true here, Ryan. And that, let me summarize. Two things can be true. Yes, we believe that, more building needs to happen, and the arrival of the new immigrants is also going to help fast track that, because we're seeing tradies, carpenters, builders, and all of that as part of the mix of people coming in. So we get that critical labour supply that can do that. The other thing we also need to see is obviously less restrictions on NIMBYism in terms of not in my backyard and getting those planning approvals through. That's going to be critical for the supply story. And so for those people who are aspiring to own property, which we hope everyone who listens to this Property Couch does, that one day they are a property owner, because it's also critical for their net worth and their financial peace story in terms of what they're trying to build out. But what can also be true in the same conversation is that there can be an asset class or a section within that asset class that might provide a superior return. And we're arguing that superior return over the decades, not the years, but over the decades, is where that land is and where that land is located and the productive use of that land. And ultimately, that's what we're teaching our clients. And we're also saying needs serious consideration for those who are doing it by yourself without using a professional advisor. And so we've got to be true to our core, and our core is that's where we see the best opportunity for returns. If you can get that land to asset ratio in those right ratios we've talked about in the past, that can also be true as well.
Yeah, it's a good point, Ben, that we want to just make sure that the discussion or the narrative is correct in our views, right? Because to your point, Ryan, yes, we do have more influence than we ever expected from this podcast. So we are aware of the responsibility that comes with that. But we also see ourselves as a shepherd to the flock, right, into our community. So if we've got 100 people and one gets out, we want to go and rescue the one and bring them back in, right? So the Property Couch is still a secret. There is still a lot of property investors who do not know who we are, that we exist, that our platform is available, right? So if we had the opportunity to have a platform that spoke to everyone, well, then there may be some responsibility around that narrative to make sure that everyone doesn't disappear from the brand new space. But we're unashamedly trying to get our listeners, our clients, the people who believe in our message, to optimize the way that they can get to $2,000 a week. And to Ben's point about land to asset ratio, that is best served by you being in a position where you can get the highest land to asset ratio that you can. When it comes to brand new, I've been on record saying be the second or subsequent purchaser. So if there is something that you like, ideally don't be the first purchaser, because you will be paying builders margins, developers margins, and marketing margins, right? So if you can cut that out, that's obviously better for you as well. But we're of the view that there needs to be a lot more supply. we are of the view that some of that supply is, the new supply is going to come from new construction. So, and if that's a lifestyle choice that you want to make to live into, to just sort of double click on some of the things that Ben said before, that's important. So we want to differentiate between investing in new and living in new. And for some people, they can get onto the property ladder by buying a 1-bedroom apartment and then upgrading to a 2-bedroom townhouse and then upgrading to a 3-bedroom house and then upgrading to their dream home. We are well and truly advocates for people getting onto the property ladder and using the ladder to climb their way up. But just be aware that the realities of supply and demand and the land to asset ratio, and if you are buying in these higher density places, they are providing lifestyle and emotional benefits to you, but the financial benefit may be limited to the extent of the amount of equity that you can create through reducing the loan. And hopefully the scarcer that you can get in some of these medium high density, if it means that's how you get into the property ladder, the better chance you have of getting some organic capital growth from the asset as well. So all we're saying is supply is the enemy. If you're buying into a place where supply can be increased, greenfields nearby or a new tower that can be built, that will be the enemy of capital growth, and that's the game that we want to play as investors. But if it's a lifestyle decision that people are making, which are the majority of the decisions that people make in this country, the rough ratio of that 70-30, 70% are doing it for owner-occupied purposes. It still serves a very good purpose for supply to come into the market to ease the affordability issues and all of the stuff that we are big advocates for. But our optimized approach is that you would look to invest in established properties with the highest land asset ratio you can.
Now, Bryce, we also had some data back when we were debating this with the Labor Party around negative gearing, and they were arguing that most people buy existing and that no one buys new. And then we got our friends from the depreciation industry to have a look at the data, and it was around 60% versus 40% of depreciation schedules at the time before the Liberal Party banned, effectively some depreciation on existing properties. So our message to Ryan is also, and to Bryce's point around, so we represent about 30% of the buying market at the moment, and you're sort of looking at around 140 to 160,000 new dwellings being basically constructed every year. That is come down at the moment because obviously of the cost of building and labour shortages and so forth. But that's going to eventually come back up. Now, what we do know from an advisory business is that there are a lot of businesses that promote the sale of new apartments, new off the plan, new house and land packages. And some of these businesses, the bigger businesses, are doing hundreds of these every month, right? So we do know that there are investors who are happily investing in new. We're talking about a minority of the investor market who are doing it using existing property, and we are definitely trying to increase the awareness of people who are looking to invest in property to also look at existing as a means by which they can potentially get a safer return and a solid return, as opposed to the risk of going into those new markets, which we're being sort of advocating for. So yes, we know that through this podcast, and obviously starting this back in 2015 when we were talking about people getting ripped off and being vulnerable to these salespeople who were selling them into high density apartments where there was no scarcity, or into new estates where again there was no scarcity, which was a greater risk of getting negative equity or losing money on that property, or waiting for that property 5 or 6 years to actually grow in value. That's the story that we're telling, because it's part of the work that we do as part of trying to drive people into safe investing over the longer term.
Yeah, well said. And just so we can help a few of our community too, Ben, we're not going to be totally rusted on to the view going forward, because the market will change and people need to adapt and accommodate to that. So if you go back to our earlier episodes, you'll get some people quoting, we say you've got to be close to the CBD and you've got to be within the 10-kilometre radius. Well, we were speaking to the conditions at the time. We were speaking to the price point, the affordability, the amount of people that needed a house at that time. Whereas now we've evolved and the market's matured and people have become borderless and there's money coming from interstate. So all of a sudden, water's finding its own level. And as we look around the country, we can see that instead of saying, hey, listen, I will only spend my X amount of money in this one market, people are now going, where can I spend my X amount of money and where does that exist? And so that has had a leveling effect across the market as well, which means you then have to push out to various satellite cities. We have to look to other alternatives. People might not be able to chase growth first. They might need to get a more of a balanced asset. So we're not fully rusted on, and at some point in the future, there might not be an opportunity based on government's incentives or whatever to maybe consider brand new, particularly for people that want to get onto the ladder in the first place. But ultimately, we find that a lot of those incentives create short-term spikes. And if you look at it through the microscope, it looks enticing. But if you look back through the telescope, if you're playing the decades game and looking over a longer period, we're still going back to the basic rule of the higher land component, the higher land asset ratio you have, the more likely the properties are to deliver above average performance, given the fact that people would prefer to have their own stake of the earth and they want as much of that stake as possible. And that'll come from larger blocks, moving to the dwelling size, and then eventually moving up their scale as they navigate the buyer's decision quadrant and work out which of those four components that they will compromise on. So I guess just want to put a little caveat here that it's not 100% rusted on, but what we've talked about in the Spruker episode, what we've just talked about now, have stood the test of time. They are evergreen principles that have stood the test of time, but there is a place for brand new in the marketplace, Ben.
There is.
All right, let's move on to the second question from John. Hi, Ben and Bryce. First of all, thank you for sharing your expertise. I love listening to your podcast and have learned a lot about improving cash flow through the More platform and strategies in the Armchair Guide book. One thing I've noticed is the case studies in the part of the strategy is paying interest only in the accumulation phase. I'm assuming after that is paying your non-tax deductible principal place of residence debt, followed by the IP with the highest rate and so forth, since the goal is to reduce debt to achieve passive income. However, my question is, how easy is it to apply interest-only loans for all properties while in the accumulation phase? I know that having an investment-savvy mortgage broker is crucial in this process, but do banks usually allow you to have all interest-only loans? And considering they have 3 to 5 year terms, is the process to keep applying interest-only loans while in the accumulation phase? If one is able to pay principal and interest for all loans, and also pay a little surplus for the principal place of residence, will that still achieve the same outcome of paying down debt early and achieve passive income, Ben?
Thank you for this great question, John. Let's start by putting things into some context, because I always like to get some context around this. We wrote the book back in 2015, 2016. I think it started to really get traction in the market. Now, when we started doing property investment plans, we started doing the pilots of those around 2009, and we started to do those more seriously around 2011, 2012, once we worked out effectively all the modelling that we wanted to do. Now, lots has changed since that time, including the way in which APRA approaches throttling the lending market, right? So their job is to maintain a structural safeness in the lending market, and they do that by certain macro-prudential interference. And what they do is they introduced interest rate throttles, interest-only lending buffers, all these types of mechanisms that has changed the market. And it also meant that the banks then started to adjust premiums for interest-only versus P&I. So now you pay a premium if you want to have principal place of residence as interest only. If you want to have an investment property interest only, that's the highest premium you pay. So effectively, there's 4 pricing scales. Now, we didn't have those pricing scales when we wrote the book, but back to Bryce's point, these are evergreen principles. And so based on your story, this is effectively what we would be saying to you in terms of your circumstances. We do believe that it is beneficial to have interest only as part of that lending story if you're in the accumulation phase. But it really does depend on what part of that phase that you're in as to whether you're able to do that. And so to answer your question, will banks allow all interest-only lending? The reality is that that's going to come down to a serviceability test. So when a lender looks at your existing exposure in lending and also new lending that you're potentially going to do, they are going to factor in new considerations around how they service that loan. And a classic example is this. If I want to take out a 30-year loan, but the first 5 years are going to be interest only, you'll usually find the majority of lenders will assess that loan on a repayment of P&I from 25 years from today, as opposed to using any type of servicing at interest only at a 30-year loan term, because obviously that would mean that the repayment rates are significantly lower, which means you can borrow more. So there has been a lot of adjustment and pressure, including buffer rates that have been also implemented by APRA in terms of slowing down the amount of money people can borrow. And that plays into this story of whether you can go all out interest only or not. And that's just about how much income you're generating and how much surplus you have to allow the banks to have comfort in basically doing all of your lending interest only.
So anecdotally, we've got clients who have interest only across their portfolio. My own portfolio, I've had interest only across the portfolio, even including principal place of residence debt. My first property was in 1998, Ben, and I had interest only lending the whole time across the portfolio. And I've never been forced. I have been asked to pay principal and interest, but I've never been forced to revert back to P&I because I've gone through the cycle and then I've extended it, and then I've just gone back and reset the lending and changed lenders if I need to to get another interest only period. So I guess the basic to the questions we got here, will the banks allow you to have all interest only loans? It's definitely possible, subject to serviceability, so that's no problem. Considering after considering over 3 to 5 year term, is the process to keep applying interest-only loans while in the accumulation phase? Ideally, because if your accumulation phase includes paying off your principal place of residence, then you have the most tax optimized environment to get the cash flow back from holding the investment properties whilst you are paying off your principal place of residence. And if one is able to pay principal and interest for all loans and also pay a little surplus for principal place of residence, it depends on where you are in the accumulation phase for that. Because if doing that restricts you from actually buying other properties, well, then that is counterproductive to what you want to do. But if you've got it done, the queue's in the rack, you've bought the number of properties that you want to, and you do have the surplus, first of all, why wouldn't you continue to pay down the principal place of residence until that's totally extinguished? But you may find a scenario, because there is a surplus that you need to pay for interest-only lending right now to P&I, you may find that you will do a cost-benefit analysis of that. And in some cases, it may make sense for you to do what you've described here. So hopefully that helps. But the goal here for us, and it's been the goal in the book, and it's been the goal from what we've talked to our clients around, is just filling up buckets in offset against these loans gives you maximum flexibility and liquidity. So that's at a headline level, but in the weeds, you might find on a case-to-case basis it makes sense for you to adopt a slightly tailored approach to which would be a better outcome financially for you.
Yeah, because back in the day, if you could have interest only on everything, it gave you surplus cash flow. That surplus cash flow meant higher borrowing power on the next loan. That's as simple as the story is here. And if you could have that, it means you could control a higher asset, which meant you get a better cash on cash return. And it also meant you'd retire quicker based on the models. Remember, these are all assumption models and projections over a long period of time. So what we are seeing is APRA, we're starting to get concerned about the borrowing power of borrowers, and they put some throttles around that story. But to your individual and personal story, because that's the macro view, when we get down to look at your individual particular story, that is about a case-by-case, building your own tailored solution and then seeing basically what other commitments you have in that household. So whilst we can make these, bold statements around macro policies and so forth, It really, to Bryce's point, is going to come down to your personal circumstances. I too, in my portfolio, have enjoyed extensive periods of interest only, where I've rolled over interest only periods for up to a decade before I've then refinanced to a new lender and reset that borrowing power back to 25 or 30 years. Because when I'm in the accumulation phase, it's about controlling a base load level of investment properties that is going to deliver me that passive income over time. But then as you progress, you sit down with your investment savvy broker and potentially your property investment advisor, and you start to look at the numbers to sort of say, can I afford, especially on your principal place of residence, once you tap out the offset balance on that loan, so effectively you're debt free on your owner occupied principal place of residence home, you then focus in on your most expensive debt with that offset, and you start to build off that one. And that is where it's like, okay, well, how do I bring the interest rate down on that? Well, have we got enough extra money there to cover principal payments in addition to the interest? Yeah, we do. Okay, let's wipe off 25 basis points or 35 basis points on the current interest rate by switching over to P&I. And then that becomes a good news story as well. So you have all of that liquidity in the offset bucket, but ultimately you're also able to then call that money through that's paying principal and interest. So it is about fine tuning all of those loan splits to make sure that you've still got liquidity in the event of an emergency. You've got adequate buffers that will carry you through 6 or 12 months of interrupted income for whatever reason. And then you start to shave off and make those the most competitive or cheapest interest rates that you can get. And then all of a sudden you're out the other side where you're no longer in that deep accumulation phase. You get to the middle ground, you can see the end, the finish line, and then you basically roll off the remainder of that debt as quick as you possibly can, as at the most effective rates you can possibly get.
And what Ben's talking about there is effectively a borrowing strategy, not just a borrowing capacity. And that's kind of illustrates why we've talked over a long period of time about talking to an investment savvy mortgage broker, because they can get the strategy right, shuffle everything around in a way that maximizes everything to optimize for tax, optimize for your cash flow, and optimize for the rate that you're paying. So just a little shout out if anyone wants any help from an investment savvy mortgage broker. A lot of the conversations we're having here, Ben, we have with our team, and they're able to help clients do that. So if you've got any queries around that for you, feel free to reach out to us and we would love to help you. The third question here, Ben, is from James and asked the question of a creative way to increase buffer. This one's a speak pipe, so let's have a little listen to James's question now.
Hey guys, love the show. Thanks for all your advice. I'm in the early stages of a plan with Amanda. Thank you very much, Amanda. We're on schedule to purchase our first investment property in December. Currently on track building up our buffers. With all the current mortgage increases in cost of living and et cetera, that buffer's being harder to save for. So a question around trying to advance that buffer by cashing out some of my long service leave. I've got around about 6 months long service. I'm 42. Been in the same industry for 20 plus years, so wouldn't have a worry to cash out half of that and use that to increase the buffer earlier. Or would it be better to stick to the plan, try and save to create the habits of saving for the plan? Appreciate your advice. Thank you very much.
Good question there, Ben.
Yeah, it's a nice question, and it's obviously, James is thinking outside the box in regards to how he can basically get himself into the property market sooner. And it's someone who is in those sort of early 40 years and they have a bit of equity behind them, and they're now starting to think, if the family's stable, they're starting to think about their future. They're starting to think about building that passive income that's going to supplement their super and enjoy that retirement. So you would think naturally it's logical that we've always said the best time to start in investment property was 10 years ago. Obviously, that time's passed. So the better time to start now is as early as you possibly can, where you can confidently assess your job security, confidently assess where you're at from a buffer point of view. And by doing what James is looking to do, that will fast track that particular story where there might be better buying opportunities. that is the honest truth around, on paper, theoretically, that's the best thing to do. But we definitely want to be able to build up this muscle memory around better saving habits, less spending. So what we don't want to see people ever do is access super, is access their long service, is access any of these savings accounts or money that's due to them, and then basically put them into investments into assets that depreciate or into things that feel good in the short term but basically don't have any long-term value. So this is another good example where if James is happy to sacrifice what might be important long service time to recharge, reset, to go again in the business, then if this is a finance question and a money question, that's going to build up a higher buffer. It's potentially going to allow him to feel more comfortable, his family to understand that they've got that position, and it may mean that they can move a little bit earlier in this particular case.
It's a risk profile question too, isn't it, Ben? It's just in terms of, because they've got a plan, they're working towards a blueprint, and so it's just a risk profile. How much buffer do you need to feel confident to go ahead, right? But the cost is a bit of lifestyle. So if you're at 42 and you've been in the industry for 20 years and you want to cash out some of your long service leave, arguably you've earned the right to take a bit of time to refresh, recharge, and get back. So the cost is actually a lifestyle. But I think in this case, what's really encouraging about the way that they're looking at the buffer question here is that it's investing, not spending. To your point, Ben, I'm actually going to cash out in order to put into my investment bucket. I really love that. So it means that they can get into the property sooner, have some comfort around holding that property, particularly with other pressures that are going on in the household. But if the cost is some lifestyle now, the payoff and the trade-off is, because they've expanded time horizon here, obviously controlling more assets over that time horizon on the way to retirement could mean that retirement is sooner, or it could mean that the decisions that you get to make in retirement are better, or more surplus to make those decisions, or more time, or things that you can give back to your kids and your grandchildren, all those sorts of things. So there are some trade-offs here, but I think ultimately, we can't give advice, but it seems like a good strategy to channel it into investing, provided there's all of the other safeguards around the plan and it makes sense and it stacks up and there's no risk. But for me, it's a risk profile question, because otherwise it's just a creative way of making sure that the sleep at night factor is well and truly tucked into bed there, Ben.
Yeah, it is. And a couple of little things that you also want to consider. If you're up for an annual review of your salary, timing that is important, because obviously if you get that review and that increase, and then you get your long service paid, that's paid at a higher point. If you're close to a promotion or taking a new position that's going to allow you to have that higher income, there could be an upside gain in terms of waiting for that time before you access any of that annual leave or long service leave that you've got there. So all of those things just need to come into consideration. What we would hate to think is that, you're 2 weeks away from your annual review and you might be expecting a 3% or 4% or 5% pay rise, and then you access your long service and realize, well, that wasn't that great. A month and a half later, I'm then basically getting a higher wage, and my super and long service my long service is going to be paid on that figure. So that's all about timing and just putting those considerations. So in this particular case, we can have a chat with Amanda and she'll be able to do the model for you and show you what the impact would be. So that's the beauty of having a sophisticated modeling software. Amanda will be able to play around with that for you, James, and then you'll be able to get an informed decision in terms of what's better for you.
Good question, James. Put that in combination to a couple of things that we talked about in episode 444 on how to tackle mortgage stress. There were some ideas around increasing buffer there as well. So a combination of all those things can help fast track if channeled in the right direction. So good question. Thank you for that. Last one here is from Paul. Paul's got a question around what to teach your kids around money, Ben. So here it goes.
Hi, Bryce and Ben. Thank you so much for your wisdom, advice, and education over so many years. You guys were even such a bright beacon of light through the early stages of the pandemic, especially with Bryce's analogy of the car is revved and fueled and waiting to go, and how correct and spot on you were. You not only helped a lot of investors, though just your normal everyday people trying to get ahead and looking after their financial future by strengthening their mindset when all that you were hearing was doom and gloom. The reason why I wrote in is because, as everyone knows, you're not only great role models to this community, but you're both great dads as well, as being a listener from the very first episode. I would love to hear an episode about teaching kids about the importance of financial education and all the fundamentals that you speak about. I grew up in a lower socio-demographic and never had any money or education about finances given to me. I look back now and I think that was part of the reason of wanting to strive and work hard to get out of that situation, as I didn't want to live the rest of my life in that environment. Knowing how extremely valuable that experience and lesson was, I'm now in the fortunate position to be able to provide my two boys with the things I never had. Though I'm well aware of the consequences of simply giving your kids the things they want instead of the ultimate goal of teaching them the value of hard work. And no doubt affording them the luxuries will, in my mind, be detrimental to them long term. I want them to be comfortable, as any parent would obviously want for their child, though I want them to be equally uncomfortable just as much for their long-term well-being.
Wow, Ben. There's some stuff that we can go after there, but what a credit here to Paul in that using their own circumstances as a catalyst to say, I want to make sure that I get out of that, and I want to make sure my kids get access to some things I didn't have, but whilst also being mindful of the lessons along the way. It's pretty good stuff there.
Yeah, it's the classic money with meaning or wealth with meaning, right? Like, what's it all for? What's it all about? Maybe we need to get Paul on the show, and maybe we can have a three-way talking about, bringing up kids and money management. We'll put that in the back of our thoughts in terms of what we might play around with there. Look, for me, I'm not the world's best dad. I've got some old time values around, how I want my kids to be raised. We were talking off air about this, but my boys just go to a normal primary school. Jack's just gone into his first year 7 at a private school in our local area, and Harry, my youngest, who is in grade 6 now, he's just starting to understand all of the pressures of peer groups and people wanting the best basketball runners, and it's got to be authentic clothing, it can't be copy clothing and all this type of stuff. So he's very materialistic, and so that's a worry for me because money burns a hole in his pocket. So the work that I'm trying to do is more around the classic teaching them to fish rather than obviously catching the fish and feeding them, right? Because it's very clear from where they sit that they're in a pretty safe financial position. And they've approached me from time to time and asking, so Dad, how much are we worth and how much money have we got and all that type of stuff. So although we talk about, conversations around money on the dinner table, I'm not interested in having that conversation with them at this young age around the sort of wealth base. But what I'm super interested about is the value of delayed gratification, teaching them the value of effort, reward for effort, and also work before play. All of those things are really important for me. It's an uphill battle. They want to be on their devices all the time. And I'm sort of saying, well, if you can do the homework and you can do that piece of work and you can understand the value of money, then we can start to think about the play stuff and what can happen after that. So, yeah, that's my sort of general position on this. I know that they're financially secure, but they've got to work for it, is basically where I'm coming from.
Yeah, good question, Paul. I think, first of all, thanks for the effusive feedback. I am the first to downplay my role as a dad too, Ben, because I think I'm engaged with my kids. I know their heart. I know what's important to them, but I don't. I'm born in the '70s too. I've still got some old school methods that probably don't necessarily work in 2023, Ben. But I guess I'm also having conversations with my kids over the dinner table about what's going on. They don't know net worth, but they do know things like there's loans, there's interest rates. The interest rates are impacting those. It's putting extra cost into the portfolio. I talked to them recently. I had to do some expenses on the roof on the property, and I told them how much it cost and what they actually did, so that they could see that there was costs involved as well. I told them recently we had a rent review and what that looks like, and they know how much the tenants pay. But Andrew and I quickly pull them aside, and we also teach them about what that means in the playground, like you, Ben. So they don't know the net position. But what we've also tried to teach them is, hey, listen, some of your friends, a lot of them, in fact, their parents won't be property investors. And so if you're having conversations about trying to one up them or show off in any way, I mean, our house is pretty humble, so it's not like the
Yeah,
Kingswood
I can
Manor,
vouch
Ben,
for
but
that.
it's,
Yep.
hey.
I can vouch for that. You guys are humble for sure.
Yeah, it's a humble house, right? So it doesn't stand out in any way. But I guess if they're having conversations around the properties and the tenants, but I do want them to understand it. I do want them to make sure that they know that investing is normal. That is normal in our household. It's not something that is out of the box. It is something normal. We do teach them the value of money. I had a conversation with the boys and I walked them around and I said, hey, listen, this light on here and this heater on here, um, they're happening in rooms that no one is in. So if we want to actually spend less money on those things, that means we'll have more money left over to buy a wetsuit or a surfboard or go on a holiday. So we're trying to give them basics in the value of money. There is some budgeting that we go through. We do talk about delayed gratification. They do earn money for their chores. And I guess my thing is I'm trying to get them to increase their financial literacy at the level that they're at. So for context, they're 10 and 12. And I talk to them about, I want to help them increase their skills. I think the more skills we can give them, the better that chance they have to earn more income at some point in the future so that they can actually use that as an asset to build wealth over time. So they're the kinds of things that we're doing to try and make it fun. We're talking about it over the dinner table. We play. We've played Monopoly. We play Robert Kiyosaki's Cash Flow, Ben. We're playing Monopoly Deal. So there's a few things, and I talk to them when there's an opportunity that comes up. And we often give them to plan a dinner. So on the weekend, we'll say, here's the budget and here's what you can do. And you can go and spend that budget and you've got to make sure you get dessert and there's enough for all the people. We've done that, which is a lot of fun. And then when I go to a restaurant, instead of, can I have this, can I have that, can I have that, Andrew and I pre-walk in and we say, this is the budget that you've got to spend at the restaurant. Knock yourself out. You can buy whatever you want as long as it's gluten-free, which is a challenge in itself. But you can't go outside of that, so that they then go and work it out. And that's been a real big hack for us because far out navigating that in the middle of a restaurant when you're at the point of decision is a nightmare. So that's how we've got around that. So there's a few things, but I don't hold myself up as a beacon of property education for kids. I'm still a work in progress on that. I was talking to you before, Ben, around how I've matured my thinking a little bit, whereas I thought one of the drivers for building the wealth base was so I could just pass it on to the kids. But I've since learnt and read and spoken to a number of people around the danger in handing the Ferrari over to a P-plater. So that could just be just as detrimental as anything. So Andrew and I have had discussions around being the bank of mum and dad to help them buy a property to get into, but then they'll be on their own. And then talk about how we can distribute the wealth over time to other people who need more money than us. So, but there's no automatic inheritance, which was a part of my initial thinking. But I'm not so convinced that would be so helpful for them. I want them to have the resilience and the drive and the understand the benefits of hard work. So there's a few things to riff to our question here from Paul, but I appreciate the feedback, but I don't think I should be considered a beacon of parenting or passing on the skills to the kids.
Yeah, I mean, you look at some of the people, right? That we're obviously living in an affluent area of sort of parts of Melbourne, and we do see, like I see kids coming to school who are 8 or 9, and they've got Apple Watches on, they've got phones, and I don't get it. Like, I don't understand. Like these kids that are automatically getting all of the latest and greatest to keep them happy. There's certainly it challenges my understanding of how you set expectations and and how you do that. Now, I don't know how those kids got them. I mean, I don't know. Did they do a recital in front of 1,000 people, and that was their reward for the many, many hours of piano that they've done? I don't get it, so I can't judge that. But I can see, families that are closer to us in our network. I do see a lot of spoiled kids, and I do wonder in terms of how that's setting them up. Back to your point before about that delayed gratification, and I've got our own story right there. A couple of weeks ago, Harry had a mate over, and Jane says, "Go inside, boys. It's a bit too cold to stay out the front." We've got a basketball ring in the front of our house, and Harry decides, no, him and Ned are going to stay out the front and kick a soccer ball around. And of course, what happens? The soccer ball goes into the window, right, and smashes one of the lead light windows on this 1927 Cal bungalow house. So it's one of the original lead light windows, right? And so, I don't know what happened. I said, I know what happened. First of all, we've told you never kick the soccer ball in the front part of the house, right? You've done that. And what it did is it ricocheted off a pot. So it smashed a pot on the front veranda and then punched into the window and smashed the lead light window. So far the quotes are around sort of $600-700 to repair this lead light window. And I'm like, Harry, what's the consequences? Oh, it was an accident. No, but what led up to that was basically going against everything we told you to do. And so there's got to be consequences. So I'm now working on a payment plan. So he realizes at the end of the day, because he's like, no, you won't do that to me. Like, no, we're okay. It was just an accident. And I'm like, here we go. So that's the challenge I have in my household, where I've got someone who loves money, who wants everything, wants to be, accepted in his peer group. And then I've got Jack, who's just a delight. Well, I don't care about money. Money's not a problem. He's got he doesn't spend it. It's all sitting in his bank account. Harry's the one usually coming to us saying, I want to download this new thing and I want to pay for this and I want to buy this. And these are the new shoes that I want for my birthday. And it's like, it's just constant. So that's the challenge you've got, as a parent, when you're seeing what's happening in the network of families that your kid's involved in, and then you've got to try and be Mr. Grinch. You don't need a mobile phone whilst you're in primary school. In some exceptions, that might be the case if both parents are working and, your kids need to be picked up after hours and a few other things. But in reality, I just see too much happening too soon for these young kids. They're going to get bored. So they've got to learn to build up and wait for something is one of my, sort of mandates in terms of what I'm trying to teach.
My wife talks openly about a conversation where her parents made her wait before longer than her peers for high heels or putting on makeup, and very traditional parenting background there, and she looks back now and sees that as really defining moments, and sees it really positive, whilst at the time felt that it was quite negative. And so she learnt to look forward to it, and had that anticipation, and obviously set her up for the future as well. So I think I'm I'm not going to pretend I'm a sage here, because I'm navigating all that stuff for the first time too. But I do remember some of the stuff that my dad did, and they're similar stories to what you've just described with Harry for the window. There was consequences for actions. There was appropriate consequences for actions. I remember the first time we went on a holiday, 1986. Mum and Dad said, "We're going to Bali." And I'm thinking, this is incredible. But they go, just so you know, we're going in about 12 to 15 months' time from memory. It was Christmas and it was the following year. So if you want to spend anything on the holiday, start saving now. And I remember that, just having that goal and then getting there, and the satisfaction of buying all those $2 cassettes, Dire Straits, Brothers in Arms, all that sort of stuff, Ben. It was exciting and exhilarating, and I still remember that to this day as a 48-year-old. So I don't think it's a bad thing, but I'm still navigating the same versions of those stories in my kids now. So hopefully, then when they're my age, they look back and go, "Gee, some of that was developed under fire back when I was growing up." So
we're both work in progresses, mate.
Yeah, well. So that's why I didn't want to be held up as the beacon for parenthood in that feedback that we just received, because the only thing I work on, Ben, is I know that love is spelt Time, and I'm trying to do as much as I can with the kids around that. But I've got a long way to go. So good question. Thank you, Paul, for that. Thank you to our other questions too, from James, from John, and also from Ryan. So there was a fair bit in that, and hopefully that has helped you today, covering a whole range of topics. Hey, Ben, this is normally where I go, this is my life hack, but today's an exciting day for me, mate, because I just put the hands behind the head.
Doing my work for you.
I lean back and I go, hey, listen, you sent me this little one during the week that you'd like to include. So around course correcting, Ben, life hack.
Yeah, so look, the backstory of this is a really simple one. It's an observational thing for me that I've sort of been able to develop after a lived life of 52 odd years. And it really is just about passing on a message around course correcting. So I see it often happen in politics. I see it happen in households. I see it happen with individuals where they can move from extremities based on certain situations. And I've always thought that the better way to get through life is to try and focus in on, just course corrections, not radical tacks in terms of changing, basically 180 degrees from one side to the other. And so, like anyone else, I've had strong convictions, strongly held until such new information has been presented. And so that is done pretty well for me in life, in the sense that I've very, very rarely made money mistakes. I've very, very rarely made investment mistakes. And that is purely because of the fact that I've never really jumped from extreme to extreme. This is the next big thing. This is what's going to happen over here. I've just, for whatever reason, been relatively sensible about that process. So all I wanted to just share here is that, the best governments are in the centre. They just tweak policy. They don't radically change it. Any time that there's massive change, there's usually course correcting that needs to happen. NDIS is a perfect example. Wonderful policy, poorly implemented, and now we're basically going to take 20 years before we actually settle that one right, where we're getting the balance right between needs and wants and desires. So I just see that happening, and I see that happening in investing circles. Oh, shares didn't go well for me, so I'm off shares, and now I'm going to try property, and property didn't go well for me, so I'm in total extreme. I'm over the shares. So my advice is just simple: just course correct. Don't overcorrect is the little life hack for me, in terms of, if you can do those things in most things in the life and stay roughly in the middle, you're going to be all right. Life's going to be pretty good for you in terms of how you do it. So that's just a little life lesson from me, mate.
I like it, mate. Charlie Munger says compounding works best when you don't interrupt it. So you're kind of saying a similar thing where, the rocket is on track about 3% of the time, and 97% of the time you're making small adjustments, but it doesn't need massive ones along the way. So I think that's a really good message, and hopefully people can take that away today. Now, you've got a fair bit you want to cover in what's making property news today.
Well, thanks for all those people who hung around. We said it at the start of the show that we're going to go big on some property data. So let me queue up a few things before we go to the big reveal. The first one is a couple of bits of media that came out this week. One, some research from Queensland Real Estate Institute, REIQ. They released a very fascinating bit of data that sort of says that around 80% of investors in Queensland would consider selling their property if the government continues to put more and more restrictions and taking more and more control away from the owner of the property. So that should be a little bit of a wake-up call and a red alert for that particular government, because we've obviously been seeing that around the place. In addition to that, we also had a story that came out recently in regards to the scrapping of their land tax proposal. And so what we did see was one of the quantity surveyor groups, MCG Quantity Surveyors, and their managing director, Mike Mortlock, he actually did some analysis regarding these people sort of fleeing that particular market. So the 98 days between the policy being announced that it's going to come into play and then obviously then being retracted, they saw a real percentage change in the number of people that were buying property. So prior to the changes, the report states that Queensland was the nation's top population for investors with 40.9% market share of all investment transactions. And then that dropped to 33.6% which is obviously 7.3 basis points, or a drop of 17.8%. So to say that governments can't influence the decisions that are being made from property investors, well, it's really starting to show up. And I've been tweeting recently about the hottest property market in Australia right now is Perth, because they've just announced that they'll have a no clause evictions will be maintained, because they also saw that basically investors were leaving that market. So they didn't want to rock the boat too much. And so now we've got what we would call an investor-friendly market, a more investor-friendly market over in WA than what we have in other states and territories. And we're seeing that in terms of this, extra COVID supplement tax that the Victorian government has announced here in Victoria. So they all just bowed into a particular story that leads into what I wanted to talk about from a data story. Okay, so what we saw over last weekend was the ATO released their percentage of individuals who claim rental or deductions against an investment property. And so this is for the 2021 financial year. And we have seen that it's still pretty consistent. The number of investors that own one investment property, 71.48%. The number that own two, 18%, 18.8%, so maybe round that up to 19%. The number owned three is sitting at 5.8%, and the number that owned four is 2.1%. And then ultimately, the number that owned five or more, you're sort of looking in that sort of 1.5% range as well. So it's clear that the percentages of investors who own a small number of properties, so whether they're accidental investors or whatever that looks like, that's shown up in the data. But that's not the interesting part. The interesting part for me is around this trend that I'm seeing in the data. And this is what I wanted to get to and what I promised at the start of the show when we did the intro. And this is about telling a story of all the different changes that are occurring. And we can now start to see that the percentage of growth in the number of individuals who are owning investment property is falling significantly. So to give you some idea in terms of the variances, let me just read a couple of years out to you so you get a sense of what I'm talking about as if you're watching the video, you'll see this come up on your screen. But what we're basically seeing here in 2016-17, there were 58,900 new investors coming into the market. In 2017-18, there were 51,574. In 2018-19, there were only 19,281. In 2019-2020, it was negative 333. And in 2021, it's 18,698. So we have fallen off a cliff when it comes to the increase in the number of investors who are owning properties. Now, remember, how this would work is that if you've sold properties, you're falling off the list. If you're adding properties to your portfolio, you're being added to the list as well. So this is people divesting of their interest in residential property. And that's super concerning. And so next to each of those years, I've talked about the APRA interventions. I've talked about the Federal Labor Party in the first election where they wanted to change negative gearing. They took that to 2 elections. We're talking about APRA putting limits on interest-only lending and a throttling around that, APRA putting a floor rate in place, and now they've got the 2% buffer rate. So that data is only up until the end of 2021. And here we are today in 2023. So you've got, since that time, you've got obviously APRA with the 3% buffer rates. You've got Queensland Labor obviously introducing a land tax and then repealing that. But you just saw from that research that meant people sold up, trying to get out quicker so they wouldn't have to pay that tax. Obviously, the RBA moving 12 consecutive rate rises starting in May of 2022, record low levels. And you've got, people like the tenancy reforms happening through Victoria, New South Wales, Queensland, the ACT, and now the WA proposals where the no grounds evictions has actually been left in place. But it's really clear that the headwinds have been coming for property investors, like I've been telling everyone on this podcast, and they're acting with their wallets. And they're basically saying, until we have confidence in our regulators and our governments of the day in terms of investing, we're going to pull up stumps. And that is chronically problematic for the number of rental properties that are available for rent. and it's only going to serve into more hardship when it comes to those people looking for rental properties.
Yeah, it just demonstrates a long run up of confidence challenges over a long period of time that have all sort of conspired to be in the position we are. So when people are trying to find out what it is, well, it's not one thing, it's a combination of those things that you've just described. What's interesting about those stats too, Ben, is you said as a proportion it's diminishing, which is true. What's also interesting over time is we always used to quote 73% of one. Now it's 71. I think you said 71 point something. And so it just means that there's been a little bit more confidence for people to go from 1 to 2.
Yep.
But still the numbers remain static for 3 plus, right? So they still are statistic outliers. So it's kind of reinforcing the conversation that you and I have on the mission of this podcast. It's to try and hold 2 or 3 of these things. Plus your investment property, plus your home, the roof over your head, to be able to get it, because that's where most people are, and that's what most people want to do without getting into active strategies. But yeah, really interesting, Ben, and I know you're talking to some influential folks around that conversation that you've just had there, but hopefully that does land on policymakers, that the unintended consequences are starting to show up now. And as you said, the data you've only got is a couple of years old. That's because of the legacy of the ATO not having everyone's tax returns lodged, on time in a timely manner. So they release it in the past rather than having it fully up to date. But yeah, it's starting to show up, and as more of the last year's and this year's data shows up, it'll probably likely further reinforce the points you're making.
Yeah, which is a real sad fact. And we've got people lobbying the government really intently at the moment about these types of rental freezes. And there's also a report that I've mentioned earlier that's circulating around saying that, so-called peer-reviewed report that says that some of these changes in tenancy reforms hasn't impacted the level of supply, which is complete bunkum. And so, our job is to bring the truth to the table based on the data that we're seeing, when all of that data was basically before 2020, that they're basically got this 2022, 2023 report that's circulating around governments and decision makers, when, again, the data is pre-2020. So I'm sure you could argue that it didn't impact it because none of those policies were actually implemented. Now that they are implemented, it does feel like a death by 1,000 cuts. There is this sort of concern that investors are being treated like ATM machines. And, so in this short term, in this bubble that we're in right now, which is this sort of 3 to 5 year bubble, be careful what you wish for, regulators and policymakers, because you are going to make things harder for people. But if I think then longer term, I only need to look at, the negative gearing rebuttal from 85 to 87. So they worked out that it was actually impacting supply. So they pulled that policy. And then we need to go to the Sydney, New South Wales, I think it was the Carr government at the time, in 2006, 2007, I think it was, where they implemented a 1% surcharge for investors on stamp duty. Guess what happened? They lost all of that investment stock. People weren't coming in and buying those new properties. So it just goes to show that, you want to be careful about the unintended consequences around these types of policies, because what investors like, whether it's investing in the next green energy plan or whether it's investing in a mum and dad investor, they want confidence and assurity that the governments aren't going to change the rules. And you keep thinking about how many times you go in there to change the rules on us, the consequences will be these. And that is, you'll get lower stamp duty revenues, which will mean you'll have less money to spend on public education, on public health, on public housing. And then you'll have to come after that revenue in higher taxes for everyone. And when you start doing that, you've broken the system. So the system is working as well as it can for the time being, but you keep playing with these rules, you are ultimately going to have to find these rivers of tax revenues that you get from property investors elsewhere, because we just won't show up. But if you say, no, we're committed to making sure that 30% of the population can have mobility and can have economic drivers that will create new opportunities, then, get behind us and start stimulating opportunities for us, not necessarily driving us out of the market, because the next generation of politicians will work this out and they'll start to then bringing in that opportunity. So that's why I'm not, on the medium to longer term, I'm not so fussed about it, because, this is about this course correction. So they'll overstretch on one side, then they'll come back and they'll realize, well, wait a minute, sorry guys, we got this wrong. We definitely need you investing. We definitely need you buying and building new investment stock. People will respond to that, and ultimately we'll get back to a more balanced market.
Begs the question, Ben, why don't we learn from history? And the thing I've been pondering of late is history doesn't repeat itself, people do. Because if you think about, if you go back to 85 and 87, what you talked about, you go, kind of makes sense. But the people who were making the decisions back then aren't making the decisions now. The people who are making decisions now were probably in primary school back then and not even part of that agenda. So history doesn't repeat itself. People do, which is why we keep on getting some of these things happening time and time again. So hopefully we can learn from some of those lessons. Whew, all right, we've covered a fair bit today.
Another big
4
show.
great questions from our community. I've announced I'm a Collingwood supporter now, which is great, and you've obviously
welcome aboard,
into
mate. Let me wait. Let me get you a scarf. I know it's floating around here somewhere. I'll go and get it.
All
for
right.
you. Let me
In fact, if I have the kiss of death, mate, I will wear the scarf. That's what I will do.
There it is. There's the get to love the team. There we go.
Bring it to me, mate. Bring it to me. You're going to get people giving you nasty mail by encouraging me to follow that team. But I'm now a converted.
Oh no, you're in. You've already announced it. So let's go to the grand final together and let's try and ride them home.
You and me, let's have a pie and a beer together, and let's watch Collingwood do what they do on grand final day. So let's. Very good. All right. So thanks again for those people. Hopefully some of that commentary that Ben's, he's been spending a fair bit of energy and time and effort around that and rallying some people around that conversation. So hopefully that advocating work that you do, Ben, on behalf of Picker is hopefully going to get some voices where it lands and where it matters the most. So, mate, until next week.
Knowledge is empowering, Bryce, but only if you act on it.
See you next week, folks.